FuelCell Energy is riding the AI data center wave straight to the bank, or I guess literally printing millions of new shares to get there. It is June 8th, 2026, and welcome to Earnings Unscripted.
Printing is definitely the operative word this quarter.
It really is. Today, we are unpacking FuelCell Energy's second quarter, ticker FCEL. And just a quick reminder up front, this is not financial advice. We are just sharing our personal opinions. So, Miro, this quarter has a serious split personality. Revenue actually ticked up 16.6% from last quarter to $35.6 million. But they posted a brutal $77.9 million operating loss.
Right. And earnings per share collapsed to, it is a loss of $1.45 compared to losing 49 cents last quarter. But look, if you just read those headline numbers, you completely miss the actual plot.
Because of the AI halo effect?
Exactly. The sales pipeline, it exploded from 1.1 gigawatts to 4 gigawatts in 3 months. That is a 267% jump. Desperate hyperscalers are realizing the traditional grid cannot power their new AI facilities fast enough, so they are suddenly looking at modular fuel cells as a behind-the-meter fix. The problem is the market was already pricing in absolute perfection.
Which perfectly explains the earnings day reaction. I mean, the stock had this massive rally during the quarter. It gained almost 70% and ended the period near $13.60. But on earnings day, it just bled out. It opened around $17.50 and drifted down all day to close over 11% lower, right around $15.30.
Yeah, classic sell the news setup. And honestly, the news had some glaring red flags hiding under that pipeline growth. You mentioned the operating loss. That's $77.9 million. Well, $42.6 million of that is just one massive impairment charge.
Down on the generation side?
Yes, they provide power for the U.S. Navy submarine base down in Grattan, and apparently the legacy setup was, failing, or underperforming at least. So they made a strategic call to just rip it out and install their standard 2.5 megawatt blocks. It secures reliability for a very sensitive military site, sure, but taking a $42 million non-cash hit to fix a microgrid is a huge bleed.
It's a bitter pill. But taking the hit now to standardize their hardware kind of makes sense if they're preparing to sell these exact blocks to massive data centers. Like they just launched a 12.5 megawatt off-the-shelf product. They want to be the quiet power generator you drop in your backyard without the neighbors complaining.
The quiet part is literally their pitch. The CEO mentioned their units operate with the noise profile of a home air conditioner, which is a pretty clever way to bypass NIMBY zoning protests. But here's the real story. While everyone is distracted by that 4-gigawatt pipeline, the company quietly leveraged their soaring stock price. They issued nearly 11 million shares during the quarter.
Raising, roughly $100 million in cash?
Over 100 million. They ended the quarter with 63.5 million shares outstanding. That's a 20% dilution in a single quarter. And they didn't stop there. They sold another 4 million shares right after the quarter closed. So they're aggressively capitalizing on this AI narrative to completely fortify the balance sheet.
All right, let's get into the details on that. I really want to look at how they're planning to deploy all this new capital.
They are pouring it into concrete and machinery in Connecticut, specifically their Torrington factory. They are actively expanding that facility to reach, I think it is a 500 megawatt annual capacity target, which is a roughly $200 to $275 million commitment over the next 24 months.
Which kind of makes sense, though, right? If your sales pipeline is sitting at 4 gigawatts, you basically have to build a massive factory just to deliver on that.
Right, except a pipeline is not backlog. A proposal is just a piece of paper. And Jason Few, the CEO, actually stated on the call, let me grab the quote here. He said, "We intend to expand capacity in line with contracted backlog, with the goal of ensuring we do not build ahead of the market."
Okay, I definitely feel a but coming here.
Oh, there is a massive but. They claim they will pace the capital, yet if you dig into the Q2 presentation, they highlight they have already installed the high-volume tape caster. They commissioned the new conditioning room, so the capital is already leaving the building. it looks a lot like they are, in fact, building ahead of the market.
It just feels like they are almost forced to jump the gun here. You cannot tell hyperscalers you have this perfect modular power solution and then tell them to wait 3 years while you pour concrete. You have to build the capacity first to even be taken seriously.
Maybe, but the risk profile is extreme right now. The average proposal size just doubled to 130 megawatts in a single quarter. These are not small local hospital grids anymore, and the CEO actually acknowledged this dynamic. He said, as transaction size increases, diligence expands proportionally.
Which makes total sense. You're dealing with data centers. It's a whole different beast.
Exactly. Extended timelines are just a function of scale. So these massive deals will probably sit in legal review for quarters. But FuelCell is burning cash on factory equipment today.
That is the brutal part of being a hardware company in this AI cycle. Software gets all the glory because they just deploy code, but if you provide the actual power, you're dealing with real physical friction, supply chains, permitting, huge metal modules.
And manufacturing absorption. This is the crucial thing to understand about their current financials. Their product revenues were actually up pretty nicely this quarter, around 18 million, mostly from some module deliveries to Korea. But the cost of those product revenues was over 20 million.
So wait, they are losing money on every physical unit they ship.
Correct. Which is exactly why they're desperate to hit scale. The CFO reiterated that they need to achieve consistent production at or above 100 megawatts annually just to finally cross into adjusted EBITDA positive territory. Right now, they're just running the factory at a highly inefficient trickle.
Wow. So that really frames the whole dilution story from earlier. They're basically bridging the valley of death. They have this heavy operating overhead, negative gross margins on the hardware, and they just have to survive long enough for those giant hyperscaler proposals to turn into actual signed power purchase agreements.
That is the entire gamble. They printed $150 million in equity simply to buy time. If those deals close in the next 12 months, management looks like absolute visionaries who perfectly timed their capital raise.
Right, and if those deals drag out in endless corporate diligence,
then they just built a very expensive, mostly empty 500 megawatt factory.
Okay, that is a fairly heavy cliffhanger to sit on. Let's zoom out a bit and look at what this all means for their overall trajectory heading into the second half of the year.
The trajectory for the rest of the year is actually, well, it is surprisingly rigid. Look, they do not give formal revenue guidance, but the CFO basically said the second half relies almost entirely on finishing up existing commitments. They are delivering the last 6 modules to that Korean customer, GGE. And then there are some upcoming shipments for another site, CGN. So the short-term baseline is sort of locked in.
Right. So there is a predictable floor there. But wait, they are still just marching toward that 100 megawatt annualized production threshold. I mean, they made it very clear they need consistent production above that volume just to even flirt with getting adjusted EBITDA positive, which is, frankly, it feels like a really long climb from their current output.
It is a steep climb, and I think this highlights the core tension with FuelCell right now. You have management leaning heavily into this massive macro shift. Jason Few had this quote on the call. Let me find it. Right. The unprecedented power density requirements of AI infrastructure have exposed the severe limitations of the traditional grid, which, to be fair, is a brilliant and probably accurate thesis.
No, absolutely. It is a phenomenal narrative. But selling the grand vision of AI bottlenecks is just, I don't know, fundamentally different than successfully bolting a 12 megawatt steel block to the ground and getting it permitted by local regulators.
Right. They are swimming in a software era narrative, but they live in the heavy industrial world, and the physical world takes time. So for investors, honestly, watch exactly one KPI next quarter. Forget the headline revenue. Just look to see if any of that massive 4 gigawatt proposal pipeline actually converts into real contracted backlog. If it does not, well, they might have to fire up that share printing press again.
The physical world is just so stubborn. Okay, I think that is a beautifully grounded place to wrap this up. Building the power generation for the future, just trying very hard not to dilute the present into oblivion.
Nicely summarized. I will hold you to that exact level of poetry next quarter.
Deal. Thanks for tuning in, everyone. We'll see you after the next earnings call.
Take care.
And hey, if you want these earnings drops to just show up in your feed, go ahead and follow the show. Also, as a quick transparency note, this entire project is generated using AI tools to analyze real financial filings, really just to see if we can make heavy data feel a bit more human. If you have a specific ticker you want us to dig into next, just shoot an email to earningsunscripted@datamadness.ca or grab the X link in the show notes.
Catch you next time.